And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
Good morning and welcome to the show. Of course, it is Tuesday, Two Dads on Money. John Penn joining me this morning. Got a lot of stuff to get into. We're going to talk about why we invest today. And again, this is it's like, well, it's obvious to make money, right? There's more to investing than just making money. And again, this idea of just chasing markets to get rich quick tends to not turn out so well a lot of times. But understanding the reality of why we should invest and why we invest money is important. So we'll go through a lot of that this morning. We're also going to touch on why you should not ever borrow from your 401k plan. Now, John may disagree with me, but I'm just telling you, you never do it. It's nothing good comes out of that. So anyway, we'll get into all that this morning, but let's talk a little bit about some things that are moving right now. Today is September the 30th. Shocker. It's also the end of the month, and we have quarter-end rebalancing today, so that's going to be going on today a bit. It's kind of started yesterday, saw a little bit of it yesterday, and then we'll see some more of it this morning. Markets are going to open a little bit weaker this morning, but again, just no big deal here, just quarter-end rebalancing. But the bigger news that potentially will move the markets is the government shutdown, which potentially starts in just a few days. October the 1st is the funding deadline, and so the government's quickly working right now to try to get some type of deal done to get a continuing resolution in place. Again, we're not going to get a budget. We haven't had a budget since Obama took office, but we'll get a continuing resolution to help fund the government through next year. But if they don't get that done, potentially we get into a government shutdown. The odds of government shutdown are about 70% right now. Now, again, we've had This will be our 35,275th one, I think. It's been a lot. Actually, over the years, we've had these government shutdowns. Last one we had was in 2018, lasted 35 weeks. The world didn't end. And let's just nip a few of the media-driven buds, narratives in the bud, here real quick. First of all, no, the government will not default on its debt if we have a government shutdown. The reason is that interest expense is a mandatory expense. Mandatory means what? Class, it gets paid. It's mandatory. It must be paid. Social Security benefits. This is one of the media favorites. Oh my gosh, if we shut down the government, seniors won't get their Social Security payments on time. Nope, not true. Mandatory spending, Social Security gets paid, along with welfare benefits, everything else. Veterans, military veterans. Yes, it's another big media topic. Everybody wants to go after that. Because, the veterans won't get their checks. Yes, they will. Mandatory spending. If it is on the mandatory side of the ledger, it gets paid regardless of a government shutdown. So when you hear these media headlines about the end of the world over a government shutdown, no, those are mostly untrue. Now, what does get cut during a government shutdown? Anything that's discretionary spending. Discretionary spending makes up 25% of the budget. So yeah, that's why we shut down parks during government shutdowns. And yes, you can't go to a national park during government shutdown because there's no workers there to oversee the park. That's one of the side benefits, but it's not an economic disaster to shut down a park. The reason we lay off 900,000 workers, well, I should say furlough 900,000 workers, because when they're on furlough, a government employee does not get paid during furlough, but as soon as they come back to work, they get paid retroactively. Those 900,000 workers are all tied to where? Discretionary programs. If they are a government employee tied to a mandatory program, they are not furloughed. If they're also involved in anything that involves protection of property or personal safety, they remain employed with the government during the shutdown. So by and large, the vast majority of all employees remain employed with the government. But again, there's about 900,000 what they call non-essential workers that get furloughed during that process. That will cause the unemployment rate to go up to about 4.7% during a shutdown, but that'll reverse as soon as they all go back to work. So again, there's going to be a lot of media narratives coming out about the government shutdowns, like, oh my gosh, this is going to be the end of the world, it's a disaster, and everybody trying to, paint a bad picture about the current administration. They're going to go to these media headlines. just be aware of what actually happens during a shutdown. We've had numerous government shutdowns in history. At the end of the day, we all survived. And actually, the markets actually did okay. There's equity markets kind of have a mixed bag during during government shutdowns, but tend to do okay following the fact. The dollar tends to be mixed. 10-year treasuries typically do fairly well because there's kind of this risk-off trade during a government shutdown. But overall, markets survive. We do fine. We move on. So just be aware of we're about to have a government shutdown. Most likely, even Vice President Pence just came out and said that Pence. I said Pence. Wow, flashback. Vance, Pence. It's all 5 letters. Same ending, right? Close enough. We all end with this, isn't it? It's with an inch. Exactly. Vice President Vance, thank you for the correction, just came out and said that we're likely going to be heading for a shutdown. So just be aware of all these things that are going on. Okay, let's talk a little bit about what you need to know before the bell this morning, because this is also going to tie into the government shutdown. The U.S. dollar. The U.S. dollar has actually been an important topic that is not getting very much attention, and you should be paying attention to the U.S. dollar. It has a lot of impacts to a variety of different markets globally. And importantly here, the dollar, while it's been weak as of late, has been putting in a very long basing period here for the dollar. Now, there's a few things that are important to understand about what the weakness in the dollar has been contributing to, and also what a reversal of that dollar strength will mean for markets in particular. Multinational companies that sell goods or products or services overseas receive a benefit of a weaker dollar in terms of their profit margins because of the trade, right? If our dollar is weaker, and again, so let's really quick back up and define what we're talking about when we talk about a weaker dollar. All we're talking about when we say the dollar is weaker, it's only weaker relative to another basket of currencies. So our dollar is currently weaker than, say, a basket of the euro, as an example. So if I live in euros, right? If I live overseas, I live in Europe, and I'm trading in euros, I can buy more goods or services from U.S. companies right now because my currency is stronger than the U.S. dollar. And so when you talk about the dollar itself, the dollar is not something that just lives in isolation. It is relative to other currencies. So is another currency stronger right now than the U.S. dollar? Yes, so the trade basket of currencies to the U.S. dollar is stronger, and that's why we have a weaker dollar right now. That's a benefit for multinational exportation companies in terms of their profit margins. If that reverses, some of that benefit will go away, and we could see weaker earnings in the future again, see profit margins compressed. And this is one thing to kind of watch right now, because corporations are running fairly high profit margins, but we are seeing some deterioration in those profit margins as the economy is starting to show signs of weakness. If you get signs of economic weakness and a rally in the dollar, then of course that's going to impede those profit margins more. So pay attention to what's going on with the dollar here. This basing period has been very, very long here, and we're starting to get some negative divergences really kind of across the board in the dollar. If we move this out just a bit and take a look at a weekly chart over the last kind of long period here, what we've got going on is we've got a very strong rally in the dollar. We've got this rising bullish trend line in the dollar. So the dollar remains in a very strong rising bullish trend right now. We are sitting right on the top of that trend line. Every previous period that we've been as oversold as we are right now has led to a fairly strong reversal rally in the dollar. And particularly, again, as I said, we're starting to get some negative divergences. We've got a buy signal on the momentum indicator. We've got a negative divergence. We've got stronger relative strength, even though the dollar hasn't turned up yet. So we're seeing some accumulation of the dollar below the surface here. The impacts of that is, if we see a rally in the dollar to about 102, that's going to trigger a couple of different things. First of all, there is a very, very large short position against the U.S. dollar. We've got one of the largest short positions against the dollar right now, kind of in history, so to speak, as a lot of CTA, these computerized trading algorithms, hedge funds, etc., have been shorting the dollar here for profit, right? So again, they just simply do this to hedge profits, etc. a very, very large short position here. So if the dollar rallies, those shorts have to cover. That's going to also help support a stronger rally in the dollar, something worth paying attention to. Secondly, any asset that trades in dollars, so you think about commodities, you think about U.S. bonds, etc. If the dollar begins to rally, that's going to attract foreign inflows into assets that potentially are a reserve currency hedge. Again, if I live in euros and I'm storing my reserve currency, I'm going to restore it in something that's going to benefit from rising dollar. That would be U.S. Treasuries and a stronger position in the dollar. That also fuels that rise in the dollar. So you've got a few tailwinds here that potentially, as the dollar strengthens, and again, you have to think about this from international trade perspective. If I live in euro and the dollar begins to strengthen, that means my currency is declining relative to the U.S. dollar. That makes adjustments in where I'm storing my reserves. I have to hedge off that currency risk to balance trade. And this is why currency is always an issue to pay attention to between two countries, because again, that all comes down to a function of trade. But pay attention to this. There's a very good setup right now for a counter trend rally in the dollar. It's also one of the most least expected trades that are out there right now, which is actually a really good setup for it. So again, when nobody expects things to happen, that's when things tend to kind of work against you. But that has impacts potentially for the stock market, for the bond market, for commodities in general. So pay attention to this dollar. It will be important when it occurs. All right, that's what you need to know before the bell this morning. We'll come back, pick up with John Penn, talk a little bit about why we invest. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
And now, another page from the Real Investment Advisor's Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show. It's Two Dads on Money this morning, and John Penn joining me in the kitchen this morning. John, how are you?
Good morning. How are you?
Good. So just wanted to talk a little bit this morning about a couple things. One is just, why we invest. And, again, this is one of those environments that is not unusual. We've been here before. It seems different this time because of all the various reasons. And if you're younger and have not actually been through a bear market yet, this seems like this time is different. Certainly makes sense. And again, this is one of those markets right now where if I simply just throw money at assets of any sort, they just go up. And that's fine, and it works great and makes us feel good. And this idea of just getting rich quick in the financial markets is fantastic. But we've seen these things before throughout history, and they tend to work out. They don't tend to work out well, ultimately, at the end of the day. And in fact, we just saw a very similar period, and again, how fast we forget things. Yeah. We just saw a similar period in 2020, 2021. We saw a lot of the same kind of similar attitudes from retail investors. They were jumping in the markets, chasing SPACs and IPOs and everything else that was just going up at the time. And then, of course, 2022 comes along, and yeah, the markets were down about 20%, but a lot of retail investors were down 35, 40, 50% of their portfolios, had a very, very large drawdown. And, you don't want that to happen to you, because all of the benefit that you got from investing in the market and building wealth, is quickly reversed when those type of things occur. And then you're kind of reset back on your heels and having to start all over again. And so the thing we have to think about when we invest is not only the how we invest, right, buying stocks, but also kind of redefine the reasons why we're investing and focus on what our long-term goals are in the function of investing. And again, right now is a great question this morning on X when we posted this channel. He's like, well, I was thinking about buying a piece of real estate, but the way the market's going, why do that and have all the trouble managing a piece of real estate when I can just throw money in the market and it just goes up? And that's a great question, right? But there's big difference to that. You buy a piece of real estate, that real estate produces income, it grows in value over time, and it won't lose 50% of its value unless you just happen to buy in a really bad location. But if you're smart about where you buy your investment, you're turning it into rentals, that will create lifelong income, and it will build an asset value underneath that with a lot lower volatility than investing in the markets. And again, investing in the markets right now seems like the easy case, but that can quickly turn. And we've seen these in previous history, 1999, 2000, 2008, 2020. You can lose money very, very quickly in the markets, if and when something eventually cracks. And I shouldn't say if, it will eventually crack. The market will eventually have a correction of magnitude. The only question is the when, and then the what drives it.
Yeah, it's so that question around real estate's a great one, and that's a question that I get a lot, pretty regular basis too, Lance. And that's, well, hey, should I just buy this income producing property? Should I buy some land and then maybe have that land appreciate in value over time, and then do I eventually build on that? And at the end of the day, before you make any investment, whether if you're buying some land or you're buying property, real estate, if you're wanting to put your money into some stocks, bonds, whatever that might be, is ask yourself, well, what is the money for, right? What is the goal? What is it for? And then too, how liquid do you need it to be, right? Because I think there is an appeal to invest in real estate or land or income producing property. But most of the time when you put your money into that, it's not very liquid. It's not like you can just get it out within 24 hours, right? So you have to think about what is your, what's the timing around that investment as well. When do you need to use the money? And so, just in fact, this kind of ties into a conversation that I had with a client last week, where their overall portfolio, they invest in stocks and bonds, but then they also they have part of their portfolio, they're investing in real estate and various rental properties. And as part of the client's overall portfolio, there's some cash set aside, right? Just sitting off to the side, earning a little bit of interest right now. And the client had expressed, hey, look at kind of this. It was almost a fear of missing out of what's going on with the markets right now. And there's an itch to get that money put to work. And so the conversation quickly became, what should I do with this money? How should I invest it? What should I do with this money, John? And I said, well, let's take a step back a second. I said, what is this cash that you have set aside? What is it for? And I found out through the conversation that this money is set aside to pay for any sort of unforeseen expense that might come up with the client's rental properties. Do they need to buy new appliances? Do they need to repair a roof? Is there a plumbing repair? Whatever it might be. And I said, as tempting as it is to maybe put this money into the market right now to try to make some money very quickly overnight, let's say to Lance's earlier point, I said, just keep that money exactly where it is. It's in cash, it's just earning interest. It's liquid, it's stable, it's there in case you need it. So even investors that are a little bit more seasoned, I think, sometimes you kind of get the itch to look at the market and this fear of missing out mentality. Yeah. But so whether, I guess going back to my original statement, depending upon, are you wanting to buy real estate or land or, looking at stocks and bonds, cash, whatever it is, if you're putting some cryptocurrencies in your portfolio, whatever it might be, you have to ask yourself first, why are you investing this? What is this money intended to do? What is the goal of this money in the first place? What is your time horizon for it? And then that can really lead you in, why are you going to invest this at all?
Well, yeah, it's to get rich though.
To get rich.
Yeah, I mean, we all want to get rich.
Sure.
So yeah, just invest in the markets, we all get rich.
It's that easy.
It's that easy. Just haven't you seen this market lately? I was talking to Mike Leibowitz yesterday. So we just rebalanced all of our thematic portfolios yesterday. Late last week, we rebalanced all the thematic portfolios on Friday, I think. And then yesterday, we rebalanced our core models. And yesterday, our crypto model was up 4.5% for the day. And there was like 4 stocks in there. One was up 50% for the day. So if that's the type of thing that if I can generate 4.5% a day in a portfolio, why work, right? I can just do this and make a living. And this is great because right now we're seeing a lot of stuff on TikTok. There's a whole website that's running right now, and they're just pushing really like through TikTok, is how to become a trader in 28 days, right? You can trade like a professional in 28 days. I've been doing this for 35 freaking years and I still don't get it right. So, all I'm telling you is 28 days of trading training. It'll give you some basic tool sets, and as long as markets are working on the upside, you'll do great. But this is so reminiscent of 1998, 1999. And what I mean by that is if you don't remember, and John may or may not remember, but back in 98, 99, there was people would set up, they would rent office buildings, and they would take like a whole floor of an office building, and they would just set up a trading center. And individuals could go up and rent a station at this trading center. They would give you a margin line to go trade your portfolio, but you could trade your portfolio and you could make money with it. And it was all great, fine, and dandy until the dot-com crash came and everybody lost all their money. Of course, you may remember that was when there was an incident where a guy showed up at one of these trading centers and started, shooting people at the time because he had lost his entire life savings, doing this trading. It's gambling, right? And this is what's going on in the markets right now. We've got a lot of that same type of thing going on in the markets, and this is where people wind up losing a tremendous amount of their savings. And again, the reason that we're investing is to build wealth long term, to fund goals, to your point. If you've got a goal for, saving up for a car, I want to buy a house, whatever it is, sure, invest that money for that goal, but do it with a sense of moderation. The problem with just investing to get rich is you've got no goal, right? You're simply just throwing money at the market and you're just taking on more and more risk, but you don't really have a goal to aspire to. And so without having a target sitting out there saying, look, my goal is to get to this level, you wind up taking on a whole lot more risk to achieve those returns. Oh, well, if I can make 4% a day, why can't I make 6% a day? Why buy an S&P index when I can buy something that's going up at 10% a week, whatever it is? Those are the risks that we get sucked into very, very easily through FOMO and through markets in general. And of course, the markets and the media is, really helping fuel all this by, hey, here's 28 days to become a professional trader and trade your way to wealth. It sounds great. They have no liability if things go wrong, right? That's all on you. And so the only thing we're saying is that it's okay. You should be investing, right? Why do we invest? We invest to build wealth, to attain financial goals, to provide security for our families, those type of things. But understand that the more risk that you take with investing also has an adverse impact on those same goals. So if you're funding to provide security for your family and you're investing aggressively and that goes wrong, it's not just losing some money, it's also the adverse impact to the goal that you were trying to do in the first place.
Yeah, absolutely. So you have to define what are your goals in the first place. Why are you investing? So the reason that we were really kind of bringing up this conversation this morning is one of our recent programs. One of our listeners, when we were talking about the different investing strategies, index, active management, growth, value, et cetera, we had one of our listeners say, well, let's have a discussion around why do we invest at all, right? Like why as people, as emotional beings, why do we even subject ourselves to these emotions, right? Because investing is very emotional. So sometimes somebody might say, hey, I might not be able to handle the emotions or the whims of investing, whether that's stocks, bonds, cryptocurrencies, investing in real estate. So maybe they decide not to invest. Maybe they just kind of keep their money in cash or money market alternatives. I mean, if you invest in CDs, T-bills, that is investing, right? You are investing your money, but it's in a lower risk environment. That's okay too. It just really depends on what is the rate of growth that you need specifically to support your goals and objectives moving forward, and then we have to figure out what's an investment approach that makes sense for you from a risk management standpoint.
Yeah.
But why do we invest? Why do we even do this in the first place? Why do we subject ourselves to all these emotions that the media can quickly penetrate and cause us to sway in all these different directions, right?
Because it feels so good when everything's going up.
When everything goes up, it feels great. Yes.
And again, and fortunately, we've talked about this before, is that we as humans have a very short memory for pain. Yes. And again, How many people remember the drawdown in April? If you're in chat right now, tell me how you felt during the drawdown in April.
Yeah, great point.
Yeah. Most people can't even remember what happened in April in that drawdown. And, how did you feel in 2020 when we had that 35% drawdown in the markets? Nobody can remember that. It's like, that was nothing.
Yeah.
It's just a little blip. It's all good. So fortunately, we have very short memories for pain, but that's also a negative from the standpoint that we have a very short memory for pain. So, all this exuberance that we have in the markets right now, liquidity's good, markets are fine, everything's going up. And that's going to probably be the case here for a while longer. And don't get us wrong that we're saying, hey, you shouldn't invest. You should invest, right? We want you to invest. We want to make sure you're putting money aside. I just had this conversation with my daughter this past weekend. Everybody was home for my daughter's birthday, and I was just having a conversation with my older daughter. And she's starting to work on saving money, putting it into a bank account, and she's starting to learn these valuable lessons about life. And she goes, I was getting some money saved up. I had almost had my $500, and my car broke down.
Yeah.
Yeah, and I was like, yeah, well, what happened? She goes, the battery died. And I was like, okay, so you replaced the battery. Yeah. She goes, it was $220 to replace the battery. And I was like, okay, well, that's life, right? And so we got to get back on to saving. And, but this is the thing about saving money, and this is why we invest, is so that we can get that money to grow, because there's going to be impacts from life. Life is going to come along, and at the worst possible time, the car breaks down, the refrigerator goes out, the dog has a vet emergency, whatever it is, and that's going to eat into that savings. And the goal is to try to keep those savings growing at a rate faster than the inflation of life is occurring. And that's a hard thing to do. But the other side of that, where we become detrimental, is to begin to over speculate in the markets, and then that has its own set of problems when it occurs.
Yeah, it does. And so all of those one-off expenses that Lance was just mentioning, you have a fur baby, a dog that has a vet bill, you need a new appliance, you need to go get a new battery for your car. It never fails. It all hits at the same time.
Always.
Always.
And it always shows up exactly when you have some excess savings.
That's right. It's like it all knows when it's time to come to the party. It's like, oh, John's got a little extra money in his pocket. Guess what? Wham! So 2 weeks ago, our youngest daughter, she's 23, car wouldn't start. Needed a brand new battery. Yeah. $225, just like that, right? Yeah. Just to go out and buy just a new set of tires for a vehicle, right? So not too long ago, our oldest daughter had a nail in her tire, so I thought I could take it down to the local tire shop and just patch it, and of course the tread was worn on all four. So guess what? She got a quick lesson on what 4 new tires cost, and that's why you set this money aside, because you never know what life is going to throw you. And then when we go buy tires, when we go up to the counter to pay, the first thing out of the young professional that was there helping us get new tires for the vehicle, the first question they said was, well, hey, we've got great financing for these. Are you going to finance these tires? I'm sure you're going to finance these, right?
No.
And my answer was, no, we're going to pay in full. And they kind of looked at me like we were crazy. I was like, no, we're not going to finance tires. We're going to, she set money aside, and she's just going to, we have the contingency set aside. We're just going to pay for this in full, right? Mm-hmm. So being able to set money aside will help, get these cash reserves set up. That way you don't have to just finance the rest of your life either. You can invest and grow your wealth over time. Right.
But this also brings back to why it's such an important aspect to have an emergency savings account.
Oh, absolutely.
Because again, this is one of the things that, again, to your question earlier, is like, there's I've got this pile of money just sitting over here that I need to go invest in. I've got FOMO now, the market's going up, and I've just got this money sitting in cash over here. Well, that's your emergency fund, right? No, don't invest that, because that whole emergency fund is there so that you don't have to dip into your investment accounts and sell assets, particularly. And again, life is really good about this. Life will show up when the markets are down. And when markets are going through a correction, that's when life also happens. And you wind up having to sell assets at distressed prices, which you don't want to do, because something in life occurred. So that's why you have that emergency fund over there, just sitting in cash. I know it's boring, it's not making any money, but it's there. So when life shows up and says, hey, time to pay your bill, you don't have to go tap into your investment account to pay those bills when they occur.
Yeah, and Pistol Pete, love your comment in the chat this morning. You're like, when did car batteries get so expensive?
No kidding.
Amen, Pistol Pete. I'm with you.
Yeah,
right?
yeah. No, I was like, my daughter said, it's like, she goes, my car won't start. It's just the battery. And I said, just go down and buy a battery. It's going to be like $70, $80. And she called back, and I haven't bought a battery like in 5 years, right? It's been like 5 years since I bought a battery. And yeah. You're due. I know, I am due. Well, unfortunately, I don't drive that much, so we'll see. But anyway, I haven't bought a battery in a while. And she's like, it's $220. I was like, you've got to be kidding me.
Yeah.
That's incredible.
Yeah, so I was like, wow, that was even more than what I was expecting. And I had this great little, I forget what the name of it, but it's like a charging station that I have at the house, and I can, fill up, tire pressure in vehicles, and I can check the status of an alternator, I can jump a vehicle, all that stuff. And so, man, before we went and replaced that battery, I was just like, let's just make sure the alternator's still good on the vehicle. So youngest daughter and I had a wonderful dad-daughter coaching session on how to rule out, yes, it is in fact the battery before you go spend $225 some odd dollars. But that all kind of, actually, Pistol Pete, that's a great comment, because this all ties back into, well, why do we invest our money in the first place? And it's because the cost of life, the cost of car batteries, groceries, just living in general as we get older, doesn't get less expensive, right? Yeah. And so I think one of the look, we want to invest because we want to grow our wealth over time, right? And there's different ways to do it, and there's different ways have different levels of risk associated with it. But I think one of the common concerns that I hear from folks is, hey, I really want to set up my wealth. I want to invest it so that way I can fight inflation, fight taxes, keep my purchasing power so I can live my life and do the things that I want to do. Pistol Pete, that your comment about batteries is all of a sudden, you go out to make a major purchase and you're like, oh my gosh, I don't remember that costing that much, 2 or 3 years ago. It's amazing how, inflation can just erode your purchasing power, right?
That's true. Yeah, and again, you said something in passing, which is the most important part, which is, why do we invest? The basic reason that we invest is to make sure our savings are growing at the rate of inflation over time. When we begin to speculate with our savings, that's where we run the risk of catastrophic losses. So part of tailoring your expectations for your investing, if you want to be a long-term successful investor, tailor your expectations to growing your savings at a rate that outpaces the rate of your cost of living, whatever that is. And again, we can all debate on that. It's different in New York than California is in Texas. But focus on that, because again, that helps moderate the risk that you're taking within your portfolio to meet those goals and to grow your savings. I know it's not as fun, right? It's like, yeah, but why just invest to outpace inflation when I can invest and I can get rich overnight? Mm-hmm. Mm-hmm. Well, you can also get broke overnight as well. That won't happen though if you're just investing to grow your wealth at a percentage rate. Again, so this is why financial planning is important, is to set those goals. Hey, I need 5% a year. I need 4% a year. And this is the part that people kind of don't understand about investing, is that let's just use some easy numbers here. So if I'm investing just to get a 4% rate of return, right? And you say, well, but the market's doing great. I'm going to stretch that to 5. I'm just going to get a 5% rate of return. That's 1% more, right? That's a 25% increase, right? But the risk required to generate an additional 1% rate of return is not geometric, it's exponential. So it requires almost 100% increase in the risk I have to take to generate a 1% additional rate of return. To get 2, I'm almost at 200% increase in risk. I've got to take on exponentially more risk to generate smaller rates of return over time once I get above averages. And so once you start reaching out there, it's like, oh, I can make 10, 15% a year. The amount of risk you have to take to do that is extremely large, and which means that, and all risk is that eventually when something goes wrong, the losses that you take are much more catastrophic.
Yeah, and again, we're not, this isn't trying to scare anybody from not investing. We just want to make sure that when you're putting your money to work, that, like to Lance's point, you have reasonable or expectations for how money can work moving forward, right? Because I remember in the late 90s, right? So I was at Schwab at the time in the late 90s, early 2000s, and that's when that's when internet trading really became a thing, right? I mean, it used to be that you would have to call your broker at whatever full commission firm and speak with your broker there, and they would place a commission to buy a stock for you. And I can't even remember now. I think commissions used to be hundreds of dollars a trade. Well, then online trading came out, right? And it just gave ease of accessibility to investors that really wasn't there before. And I remember in the late 90s, when this was when online trading was really pioneered, and then the .com phase came to be, and it was, I remember sitting with clients at Schwab at the time, and I remember like it was yesterday. Somebody said, "Hey, John, I think a rate of return of 30 to 40% per year. Hey, that's my norm. That is my expectation." And I was like, well, I had to take a step back and say, let's really talk a little bit here about how markets work, right? And so sometimes it's very easy to look at all these wonderful returns out there and just expect that this is the norm. And that's not the case. That doesn't mean that your money can't work and do well for you over time, but the two key words there, it's over time, right? This just doesn't all happen overnight. I think investing is more of a marathon, right? And you want to be consistent with your approach. If I can kind of relate this to baseball, you just want to hit singles and doubles and be consistent. Hey, every once in a while, you're going to hit a triple, you're going to hit a home run in your portfolio. But I think it's better to take a more consistent approach to this over time. Lance, there is a younger generation of investors out there where they haven't gone through a .com crash. They didn't go through a 2022. They didn't go through a economic shutdown in Q1 of 2020. They don't, like, that is so foreign to them, right? And in my mind, like with our oldest daughter, who's 25, she's been in her first post-college career now for about 2 years, and she is just keeping it very simple. She's investing into a Standard & Poor's 500 index fund. Earlier this year, when markets were more volatile after the Liberation Day announcement and markets hit their peak drawdown on April the 8th, I heard from her, she said, "Hey, Dad, everybody here at the office is kind of freaking out at the market. Is this something that I should be concerned about?" My response to her was, "No, kiddo, stocks are on sale, buy more," right? So, and it's all about the narratives that really influence us here too. But there's a younger generation of investors out there who they really haven't seen what market volatility can look like.
Yeah, no, that's true.
And that's not to scare anybody.
Well,
right?
No, but it is true. It's all about experience.
Yeah.
And when you've been through these cycles and you understand what the risks are, it's easier to understand the dynamics that go on. But look, let's just make this really simple. You don't have to invest and be overly risky to make money in the markets, right? The goal is to grow your money. You can buy just an S&P index fund, like John said. That's the same thing I'm doing with my daughter right now, just getting to learn the basics of how the market works. Buy an S&P index fund. You can, if you're worried about the concentration risk, you can eliminate concentration risk in an S&P index fund. You can use an equal weighted fund. You can use a secondary fund that removes some of that market concentration if you're worried about that. The power of compounding is a myth from the standpoint that investments only compound if they're going up over time. A contraction in the market destroys the compounding effect of your portfolio. So that's why the most important aspect of investing is not making money on the upside, it's protecting against the losses. So it's okay to take on more risk to try to generate more return as long as you're managing that risk profile against the drawdowns. Because again, I can compound returns as long as markets go up. But again, a very small decline in the market, 5-10%, can destroy years of compounding effect if that occurs. So you've got to be more conscious about managing the downside than trying to grab all of the upside. There's, a lot of people are like, oh, well, yeah, if money's sitting idle, it's just losing purchasing power. That's not true, right? If I have money sitting in cash today and I'm waiting for an opportunity to invest that capital, it's not losing purchasing power, it's opportunity. Now, if I'm going to leave cash in a savings account for 15 years, I'm going to lose purchasing power relative to inflation. Our goal is to invest over time to outpace inflation. So don't get swept up in this thing like, oh, I've had money sitting in an account for 3 days. I'm losing all this money. No, you're not. That gives you opportunity. so that when markets do go on sale and you do have another correction, you've got capital to invest. The biggest mistake that happens to young investors is they have all their capital invested in the markets, they don't sell anything, they don't take profits, they don't rebalance risk. So when markets decline, they're forced into a sell position rather than being able to ride that out and then have this cash sitting on the sideline going, now I can add to that portfolio a lot cheaper. So don't discount the importance of having opportunity on your side by having some cash in an investment account. And then, of course, take advantage of IRAs, Roth IRAs, 401k plans, anything that's tax-deferred, tax-free. Definitely take advantage of those as well.
Yeah, health savings accounts, if you're on a high deductible health plan, take a look at an HSA for a triple tax benefit. Your money goes into the HSA, you get to deduct that from your income. When the money's in the health savings account, that money is growing tax deferred, but then when the money comes out of the HSA for a qualified medical expense, it comes out tax free. So there's a triple tax benefit there too. So, along with all of the IRAs, the kind of the alphabet soup of IRAs that Lance was mentioning too. Traditional IRA, money goes in, you get to deduct that from your income now. With a Roth IRA, you fund that with after-tax money. You pay the tax now. That way in the future, when the money comes out of the Roth IRA, it's all tax-free, right? And so these are all conversations that we have with clients on a daily basis. So if you have any questions around just even IRAs, Roth IRAs, HSAs, what's right for you, hey, reach out to us. We're happy to be guides in those areas for you too.
Yeah. So just one other thing here. We'll save we'll talk next week about should you borrow against a 401k plan. This is one question we're getting a good bit, and we'll definitely spend some time on this next week about whether or not you should borrow against your 401k plan. There's a lot of myths about that, which is, oh, you're just borrowing from yourself. That is not a true statement. You're borrowing from the 401k company. But there are a lot of consequences to borrowing against your 401k plan, which is why my basic motto is that you never, ever, 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 never do it. But we'll get into all those details next week and go through all the pros and the cons of it. There's very few pros, mostly cons.
I think Lance already has this conversation decided, but we'll talk about it.
We'll discuss it. We'll discuss it, but you're going to lose this argument. The math is not on your side. But yeah, we'll definitely get into that next week. Be sure and get by the website, realinvestmentadvice.com. Our latest blog post is out yesterday talking about the markets using RSI to basically calculate the next downturn. I've got a couple of articles coming out over the next week or so talking about economics, talking about several other myths that are going on in the markets. We'll also have this impact of this government shutdown coming up. Our daily market commentary touches on that today. That's all at the website, realinvestmentadvice.com. While you're there, send your questions, comments, emails. Let us know what we can do to help you. And make sure and like and subscribe to this channel. We appreciate it very much. And we'll see you back here tomorrow with Danny Ratliff on the next Real Investment Show.